Welcome to the 2019 Q1 update. If you like the video, please don't be afraid to like and subscribe at the end. All right, guys, let's jump right in. We talked a lot about mean reversion in the Q4 recap. We were spot on as we experienced the pendulum swinging aggressively back to the positive in Q1 after an atrocious Q4. This phenomenon was reminiscent of oil prices in 2007 and 2008, if you want to Google it. This recap will focus on rate of change. Rate of change refers to the momentum and direction of a particular metric. Today, we will look at several metrics including global demographics, GDP, PMI, and yields. To begin, let's talk about global demographics. We touched on the demographic crisis in the last review. I'd like to dive in a little deeper as this is becoming an even more pressing issue. More data was just published by renowned demographer Neil Howe. Howe cautions that the ratio of total U.S. workers to available employment is rapidly decreasing. A prime example of this is right here home in Colorado. There are more available jobs than unemployed working age people. Too many jobs, not enough people to fill them. That's a problemo. In the U.S., this peaked in 1998 and is projected to hit 0% growth in 2021. This trend began during the tech bubble. We experienced exponential growth, lots of new jobs, with hordes of people wanting to fill them. Great combo. Since then, we've seen continued growth in available jobs, but fewer people wanting to fill them. This is not because all millennials are lazy. It's because more baby boomers are retiring than millennials entering the workforce. Back to rate of change. This has produced an increasingly negative rate of change here. 1 to 1.5% growth in 2018. We're going to hit 0 in 2021. That's sad. Then we're projected to dip into a compression, i.e. negative growth rate. The reason all of this matters so much is when this happens in an economy, GDP can't grow. That's bad news. Now the question is whether growth is going to slow with or without inflation. These would mean two very, very different things. If we see slowing growth with inflation, that means there are some asset classes that can support positive GDP and possibly an increase in markets, global stock markets rather. If we see slowing growth without inflation, that means we're heading towards a recession. I believe we're in the former, not the latter. We're going to see slowing growth with inflation. As I touched on in last quarter's recap, this is the definition of a stagflationary environment. And I firmly believe that is still the direction we are headed. Let's talk real quick about what's happening here in the United States. This doesn't mean the market is going to get crushed. It just means we have to manage risk even more carefully than usual. In these types of environments, we will shift some of our exposure from higher beta equity to lower beta, just like we started last quarter. As a reminder, low beta gives exposure to consumer staples, utilities, and REITs. If I'm right here, these are the types of asset classes that do well in this environment. We may even dip our toe in the water and creep up the risk scale in our commodities exposure. That'll definitely work if we have some inflation. Have a quick look at this chart. Going back the last 5 years, you can see that there has been very high correlation with the Dow Jones Commodity Index and the U.S. inflation rate. This is something that goes back much, much farther than this, but the Dow Jones Commodity Index was reworked back in 2015, and we can't show a chart going back any farther than that. Additionally, bond proxies can benefit from an environment like this, as long as inflation doesn't turn into hyperinflation. The Fed will not be forced to raise rates. As such, the dollar may weaken and commodity prices should theoretically increase. Take a look at this GDP chart real quick. All right, notice the slope of the year-over-year change. That's what I'm looking at when examining rate of change. You can also see it in the inflation chart. I'm fully expecting us to float in the middle of the pendulum for a while. I don't think we'll see an extreme again for at least a little while, maybe 6 to 12 months. The same cannot be said for how I feel about Europe. Europe just can't seem to get out of its own way. In the last 6 months, they've been on a roll with non-conforming budgets, differing immigration policy, and the fact that the southern Eurozone countries actually are seeing their populations decrease every year. You think we had a problem here in the United States. I find it entertaining that everyone is calling for a massive rally in European stocks because they are so cheap. Well, I'm not saying it's not possible to see positive returns. I'm just saying a prolonged recovery would be unlikely with the very fabric of the Eurozone being torn before our eyes. Don't believe me? Let's take a look at the charts. This first chart we have here is a German Industrial Production Index. As you can see, it peaked back in spring of 2018, and the rate of change is clearly negative. Moving on, we'll take a look at the EU Economic Sentiment Chart. Same story. Peaked a little bit earlier in the year, but sentiment is definitely a leading indicator when we're dealing with growth curves. As you know, I've always touted a meaningful level of global diversification in client portfolios. However, I don't have warm fuzzies about the Eurozone. Instead, we're going to look at emerging markets for a higher percentage of our international exposure for the remainder of this year and likely into next year. We're going to focus on broad diversification in the emerging market space, and I don't have time to talk about what's wrong or right with every single country, but I do want to spend a few minutes discussing the largest and arguably most important emerging market. That's China. I'd like to point out that if you thought the demographics in the United States and in Europe are sad, you clearly haven't visited China recently. They're not quite on the same level as Japan, but it's not for lack of effort. Over the past several decades, with their one-child per family policy, they have successfully created a 50 million person gap between men and women. The big problem with this is Chinese culture has incredibly stringent requirements for courtship. In many parts of the country, if a man doesn't own property, he can't date. So the demand for real estate has gotten so outrageous they're offering 50-year mortgages. China finally came to the realization that as a country they need to allow families to have more than one kid to try to even out the percentages of men and women. Take a quick look at this GDP per capita chart. Let's boil it all down to its simplest point. Having more kids sounds like a great idea until you realize that the current GDP per capita on the chart is below the international poverty line. In case you were wondering, that line is $15,000 GDP per person. And the plan to drive their economy further into the 21st century by increasing family sizes and becoming a consumption economy is verging on impossible. Let's transition over to the trade war. We can't talk about China without talking about the trade war. The truce brokered at the G20 summit in December has held up pretty well. Everything from the last video pretty much still applies. To that end, legitimate negotiations took place in the middle of February and bore little to no fruit. The administration is not really talking about why the talks broke up, but it's blatantly obvious that China does not want to stop international IP theft. They already offered to buy more of pretty much everything, and in some cases they've already started. Keep a close eye on what happens during the first week of April as the Chinese delegation is visiting the United States with hopes of closing the deal. This has huge ramifications not only for the Chinese economy, but it will also shape the rhetoric of Trump's re-election campaign. All of this international drama is creating downward pressure on the middle to long end of the yield curve. If you saw the Monday Morning Minute from last week, we just experienced an inversion on the 3-2 curve. This chart has all of the major curves that we're focusing on right now. We're getting awfully close to an inversion on the 210 curve. In fact, the spread is so narrow, we haven't seen anything like it since May of 2007. That's not a great harbinger of things to come. One tiny sparkling light in the bond market is the fact that fear has not crept itself into the extreme long end of the curve. The 20 to 30-year bonds still have substantial spread relative to the shortest end of the curve. This affords us an opportunity to extend duration in our portfolios, even though most talking heads are not proponents of this strategy. But that's what makes investing fun and rewarding, when you can identify when consensus is wrong. We just experienced 2 consecutive quarters when the consensus has been dead wrong. Fortunately, we don't blindly follow consensus. We stayed the course, made objective decisions, and did not give in to the fear of the Q4 bears. All the data indicates we're in the late innings of this bull market, and this outlook will drive our positioning moving forward. As always, data will dictate our positioning. Continuing on from last quarter, we will shift higher beta to lower beta. I'm not going to be afraid to increase bond exposure, and we're going to take a hard look at adding additional commodity exposure into the portfolio. Our overall international allocation will likely tilt to an overweight in emerging markets. Obviously, allocations and portfolio construction are unique to every investor, but these are the general tactics for the coming months. I really want to thank you all for watching. Please don't hesitate to reach out if you have any questions at all. Also, if you'd like to have an individual quarterly review, please schedule a time in the link below. I really want to thank you all for watching. Please don't hesitate to hesitate.
Don't hesitate to hesitate.